Welcome back, y'all. You guys, hi, today is Monday, the 3rd of August, whatever it is. And if you guys were on Facebook, in my Facebook group or on my personal wall, you might have seen I already posted some updates yesterday about the S&P 500 earnings progress for the week. This week was the busiest week of the entire quarter. With updates, I had over 190 companies that I actually looked at, and 170 got actually updated. So gives us a really good taste of what actually went on with earnings performance across the broader index. So we're going to get into that information here, right? Just going to look at the broader, like index level information in this video. I will do a separate video for like sector and industry information. All right, so let's get on to that. All right, let's look at the cumulative progress review for now. So far, we have 280 companies that have updated. Like I said, I updated 170 this week. A really busy week. Like I said, also the busiest week of the entire quarter. All right, so we're looking good here. Year-over-year performance for the quarter so far is up over 22%, which is a little bit above the previous quarter. Good to see. And we're still, just hanging around the ballpark of 80% as far as what percentage of those companies is reporting positive earnings growth. 222 are positive, 5 are neutral, and 53 are negative. All right, so this is really strong. The historical mean or average that I've, at least for the years that I've paid attention to this and had records of it, is about 64, 65%, somewhere in that ballpark. So we're above the average, which is good. This is bullish. All right, so 12-month performance is up a little bit now to 12.2%. I do anticipate that accelerating to the upper teens, maybe even low 20s over time. But keep in mind, though, the 12-month performance is a lagging indicator, not much of a leader. The year-over-year is more of a leading indicator, if anything, in a way. So we know that the earnings are coming. It's just, when we start seeing it show up in here, it's really just confirmation that, hey, we actually did get the performance that we were expecting. All right, so that's what we can use for that. Just keep in mind, though, you'll probably see the earnings growth rate slow down before you actually see the 12-month performance also slow down. And moving on to this, the index closed the week at $72.761 trillion total market cap. That is above what I've been seeing over the last several weeks that I can recall. I think that I'd seen it get up to 72.4, almost 72.5 a couple times before settling back down, and it's back up to 72.761. The expected growth rate for across the index is now up to plus 16.55%. That is a little bit above what it was at, I believe, last week. I think last week I was reporting at about 16.3%, and prior to that, I think it was around 16.1, so somewhere in that ballpark. So it is accelerating a little bit, and that is good news. We really like to see that. It means more growth for stocks coming soon. And the other thing you want to get from this is what is a reasonable short-term price. And right at the moment, it looks to be like somewhere around the 7,200 range on the bottom end to 7,450 on the top end, based on existing earnings data, is what I would call reasonable. I believe we closed real close to that range. I think just a slight bit above it, like 50 points above it, like 74.97 or something like that, if I remember right, was the closing price. We'll get to that on the other video, by the way, I think. So we're looking pretty good overall as far as valuation is concerned. It's just now, if we can keep it there and then just let it track earnings, it should be more predictable, make me a happy camper. All right, as far as the beer ratio, those are guys who are TSP retirees or have 401ks, whatever, and you're retired and withdrawing. This is what those of you guys who are in that category are who I recommend this for. And I only recommend this if you have a sufficient account balance. The easy way to tell if your account balance is sufficient is to take your account balance and divide it by 240. And what that does is basically amounts to 20 years of monthly withdrawals, and which is about a 5% drawdown rate. You might even want to divide it by 300 if you're wanting to be a little extra cautious. But generally, I say 240. And because if the S&P 500 grows at a roughly 10% average rate, and you're drawing down about 5%, your account balance should still be able to grow by about 5% on an average on a typical year. Okay, so but I know some of you guys want to be more conservative. So if that calculation is sufficient for your needs, if you're already retired, and if that whatever that amount is a number you can be happy with, then maybe consider doing an 80-20 mix between stocks and bonds. And if you're in TSP, that would be specifically 80% in the C fund and 20% in G fund. For those of you guys with 401ks that are not TSP, you guys don't tend to have fund names. I think they tend to be named after whatever they follow. So look for anything that's like Fidelity 500 or something along that line. Something usually has 500 in the name, and it's, or Fortune 500, whatever. Anything that resembles S&P 500 is the fund you're going to want. And the other 20%, put it in bonds or cash equivalent type of stuff, whatever, and sit with it. The rest of you guys, if your balance is not sufficient or you're still working toward retirement, 100% in stocks would be more ideal. All right, that's my opinion. I don't get paid for this stuff. I don't do the cookie cut advice that professional analysts go with, which is based on assumptions. So that's what I'll go with for my recommendation. I want to look at the bond yield curve. That's always a good indicator of what to expect in the future as well, as far as growth rate and things like that. Right now, this bond yield curve looks pretty bullish. There's only 2 inversions right now, and they're very small. You can see one here between the 2-month and 3-month yield, barely 2 basis points. And there's one that's only 1 basis point between the 20-year and 30-year yield. Otherwise, there are no inversions anywhere in this curve. This is what we like to see. Inversions create potential for recession. When you don't have an inversion like this, you have a decreased risk of recession, because banks, they like to leverage their growth by borrowing money on this short end, so they could, basically fund more loans that go out to clients on the long end. So, we do also have other little telltale signs here. Okay, so the 1-month yield, it had briefly climbed to, I think, 3.82% last week before the Fed had its rate policy meeting, and then it came right back down to the 3.75. It didn't get any higher than 3.82. It didn't. Basically, it was leaning toward a rate hike, but not very strongly. And no surprise, the Fed ended up voting 6-3 in favor of keeping the rate where it currently is, which is the 3.5 to 3.75 range. Those 3 that voted against leaving it the same voted in favor of raising the rate by 0.25%. So not surprised that the 1-month yield went up a little bit just before right before that meeting. I think it closed at 3.8 on the day of the first day of the meeting, which is always on a Tuesday and a Wednesday. On Tuesdays when it was at 3.8, and then on Wednesday it came back down into the 370s. All right, and the other thing here, the 1-year yield and 2-year yield still being up above 4% is telling us we probably have a rate hike coming, or at least it's suggesting that we have a rate hike coming at some point in the future, just maybe not right now. And then looking at the long term, these are the 20 and 30s. They're back up above 5. They've been steadily climbing. They were down below 5 not that long ago. They got up above 5, and now they're up above 5.25. So what's driving that is inflation, of course. And where's the demand? And that's probably, at that 20 and 30-year rate, probably looking at more buying activity or spending activity is in terms of home purchasing, home equity lines of credit, or long-term business loans. That's, there's some kind of demand there for that, right? And when you have a yield curve that looks like this, and it's cost effective for banks to borrow on this end so they can fund more long-term loans on that end, that's what you're going to get. Might need to see these rates come up a little bit more to help slow that down, unfortunately. But it'll slow the growth rate down, but it's not going to stun growth either, okay? So it's just take it as this looks bullish. There's more growth to come. It may slow down at some point after we see rates come up, but at the moment, though, let's enjoy what we're getting. And lastly, we got one constituent change to the index, to the S&P 500 coming this week. That'll be Ferguson Enterprise coming into the index. They're going to be replacing Electronic Arts. Electronic Arts was recently acquired by Public Investment Fund, Silver Lake, and Affinity Partners. So they are leaving the index. And in their place is Ferguson Enterprises. They are getting promoted from the S&P 400 Mid-Cap Index. And we're going to close this out with a look at what's to be expected, or what actually did happen this last week, and what's to be expected over the coming 4 weeks. This last week had, like I said, 170 companies updated. They amounted to, I think it was a little over $70 per share and cumulative, total year-over-year increase in earnings. Yeah, this is not market cap weighted. This is just raw. Like what did they all add up to? Yeah, it increased by about 70 to 75. I can't remember the exact number. It was somewhere in that range. So that increase, that's what that had a contributor to my short-term target going up. Last week, I think I was only around the 73.50 range for my top end short-term price target. Now we're up at 74.50. So looking really nice. This coming week is going to be another busy week. I have 147 more updates or companies to look at. Some of these were spillovers from last week that did not do updates. And some of these 147 are going to probably spill over into the week of August 10 through 14. Not a problem, but we just know that it's going to be a busy week. All right, so we're going to be seeing a significant amount of the index probably will have reported by next weekend. All right. And we do expect them to increase another $50 per share and total earnings, year-over-year performance. By next week, we expect the pace to slow down significantly. Barely over a dozen there in next week, and in 17 the following week, and only 13 the last week of August. That'll be a wrap for this one. Appreciate you guys watching. I will have another video talking about the index and sector stuff for those of you guys who are in TSP, who like to invest in the TSP mutual fund window, or if you have IRAs and you want to invest a little more narrowly than broader stock index funds. Reminder, you can get better performance out of out of sector and industry funds than you can from broader index funds. So that's why I like to post that kind of stuff. To maybe help some of you guys out who want to get a little bit more bang for your buck, by focusing more. That's right. So watch for that video. That'll be mainly particularly here for YouTube and on, I think, Discord as well. I don't really plan to post them on Facebook. I've already posted the images with some text descriptions on my Facebook page. If you guys want, just check them out. If you need screenshots of any of this stuff, you can cruise by my Facebook profile and find these posts on my personal wall. They are public, so just check them out. You can use what you need, all right? See you guys later. Have a good day.